Right now, headlines tie together a military strike with global markets, and the consequences ripple far beyond headlines. An Iran-related attack threatens energy supply lines, fertilizer feedstock, and the agricultural calendar. Oil prices react quickly when risk shifts, and farmers watch input costs swing as the market digests risk premia. Fertilizer futures and crop insurance premiums respond to sanctions chatter, shipping routes, and refinery outages. Investors wonder how geopolitics translates to real-world costs for corn, soy, wheat, and feed. The stakes are not only energy economics, they touch farm budgets, freight costs, and consumer prices. Understanding this link helps managers, traders, and farmers plan with more resilience. Explaining the situation in plain terms means tracing a thread from risk to prices. An attack can disrupt crude flows, erase tanker routes, and elevate shipping costs. The Strait of Hormuz, a narrow waterway, carries roughly 20% of global oil shipments and a large share of LNG and petrochemicals. Any disruption can push Brent and WTI higher as traders price the risk of outages. Fertilizer markets depend on natural gas, ammonia, and phosphates. If sanctions or routing delays hit supplier countries, ammonia and urea costs rise. The result is a chain reaction from energy to farm inputs to crop costs. To understand this moment, we rewind decades of shocks and policy. Iran sits at a geopolitically sensitive crossroads where energy, sanctions, and regional alliances collide. The country owns sizable crude and waves of petrochemicals, yet export prospects have repeatedly faced restrictions through UN and US measures. Sanctions raised risk premia and forced trading partners to seek substitutes, modestly curbing Iran's share while translating risk into global prices. The fertilizer link is deeper still. Ammonia and urea are produced from natural gas, a commodity Iran imports in different ways. Past episodes show how supply fragility and political signals can amplify price volatility across energy, farm inputs, and grains. Markets are translating geopolitical risk into price signals. After the Iran attack, crude benchmarks spiked, with Brent trading in the upper 80s to mid-90s and WTI echoing higher as hedges and risk premia flowed through futures curves. Oil majors rallied on the prospect of recovering margins, while shipping and insurance costs extended the cost of risk. Fertilizer futures followed, with ammonia and urea quotes bouncing as gas markets tightened and sanctions talk persisted. Stock markets wobbled, while currency markets saw risk appetite tests. The fertilizer complex, age, and energy chains now test correlations as traders price possible shutdowns, sanctions reliefs, and shipment delays. Who feels the tremor of this developing scenario? Oil majors and midstream players watch flows, insurance, and refinery margins for guidance. Fertilizer names tied to natural gas face inflating feedstock costs and wary customers. Large producers like Nutrien, Yara, CF Industries, and Mosaic may see cost pressures and volatility, while distributors adjust pricing. Energy investors recalibrate exposure to integrated producers and refineries, and airlines or shipping lines reprice routes. Farmers and crop input suppliers face higher upfront costs, potentially tighter credit. Banks and commodity funds reweight risk from storage plays to diversified energy equities as geopolitics reshapes relative attractiveness. Supply chains could tighten further. Layered geopolitics and macro trends frame this moment. Sanctions in different jurisdictions collide with supply chain resilience, complicating investment decisions. The US and allies monitor shipping routes, balance of payments, and risk premia across markets. European gas markets breathe in the seasonality of winter demand, while China's growth curve influences fertilizer demand and global grain trade. OPEC dynamics, spare capacity, and refinery maintenance shape baseline oil prices. A tariff-friendly environment can soften volatility, but escalation raises hedging costs for farmers who buy futures and options. In short, energy, fertilizer, and ag cycles move together under a wide canopy of policy and macro signals. Smart money interprets this through risk-adjusted lenses and hedging costs. Energy funds poured fresh capital into integrated producers and refiners as volatility spiked, while some fertilizer groups attracted tactical bids on short-term supply concerns. Hedge funds rotated into oil long positions and energy equities, using options to cap downside while staying exposed to upside. Retail investors followed via commodity ETFs and mining stocks, though liquidity can fade during headlines. Shipping insurers trimmed risk exposure, and some institutions started overlays to manage basis risk in grain markets. Across the spectrum, portfolios rebalance toward assets with inflation hedging properties. The pace matters because timing can define a fund's quarterly performance. Bear case scenarios remind us that markets rarely move in a straight line. An escalated conflict could trigger a prolonged shipping disruption through Hormuz or Red Sea corridors, compounding price spikes and insurance stress. If sanctions intensify or a counterattack targets key pipelines, energy and fertilizer markets may overshoot as risk premium stays elevated. A downturn in global growth would crush demand for grains even as input costs stay high, squeezing margins for farmers. Storage risk grows if futures curves backwardate or if liquidity dries up in thinly traded fertilizer options. The wrong sequence of events could fracture market confidence for months. For retail players looking to navigate this terrain, a disciplined approach beats gut reactions. Start with diversification across energy equities, integrated producers, and fertilizer exposure rather than chasing a single meme. If you own stocks, consider trailing stops or protective puts to limit downside while preserving upside. For those in ETFs, blend energy funds with broader commodity baskets and consider inflation-sensitive assets. Maintain liquidity to weather sudden volatility and avoid heavy leverage in times of uncertain sanctions risk. Finally, keep a checklist. Monitor Hormuz news, gas price trends, fertilizer feedstock costs, and crop demand forecasts to inform entry and exit. Looking ahead, the Iran incident is a catalyst rather than a solo story. The path for oil, fertilizer, and ag commodities will hinge on how quickly market expectations adapt to new risk, how sanctions evolve, and how producers and buyers manage alternative supplies. Investors may see periods of volatility followed by regime shifts in pricing as spare capacity and substitute inputs come into play. For farmers and traders, flexibility in sourcing, hedging, and timing will matter more than any single headline. Stay engaged, watch policy signals, and build resilient portfolios. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.